Stocks continued their winning ways on Tuesday, with 4 of the U.S. equity indices closing at new 52-week highs. In fact, 3 out of those 4 indices hit all-time highs here today. We also saw interest rates pull back a little bit, which helped support areas like utilities and REITs. We had a few economic reports and earnings reports also in the mix there, but largely the rally today was as a result of more positive news flow between the United States and China's ability to get phase 1 of the trade deal done later on this year. So we'll talk about all of that, then we'll get into our trade application example, where I'm going to show you a stock that actually pulled back significantly here today to a level of potential long-term support. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's November 26th, 2019. First of all, if you're new, welcome aboard. Remember to go to YouTube, click subscribe. While you're there, check out our description area where you can sign up for our email distribution list. In addition to that, we're heavy users of Twitter. Feel free to follow me at Brandon Van Zee, and thank you to all of you that click like and retweet on these Market Outlook related posts. Lastly, we have a presence on Facebook. Feel free to join our group at the web address embedded in the logo in front of you. All right, let's go ahead and dive into our charts. As you can see, I've got chart 4B pulled up here in front of us, which will show us the 4 major U.S. equity indices. And as I mentioned in the intro, you can see these nice high labels right here, not only on the candles themselves, but you'll also notice that we have these kind of labels that say yearly high today that happen to show up on all 4 of our charts here today. So another big moving day for the markets as we establish new highs across the board. The Russell 2000 had a beautiful day yesterday. You'll notice a big move there, kind of pushing up and away from that moving average. It was up about 2%, so it was good to see a little bit of a follow through right there. That actually pushed us up to a new yearly high. Remember, the Russell 2000 is the only one that's not hitting all-time highs. The other 3 charts are. So we've had quite the run here in recent weeks. Of course, our posture remains bullish, as it has been, really going all the way back for the S&P 500 at least, since basically the first or second week of October. Right here on this candle, you can see that the background color of the chart changed to that light green color and has continued to be green all the way until today. So you can see that yesterday, it's hard to see right here. Down here you can see it a little bit better, but on yesterday's candle we did have an overbought cluster signal. So we'll have to keep our eye on that to see if that leads to any sort of a reversal. We did have an overbought cluster signal here as well. Didn't really lead to much. We had maybe 3 days in a row to the downside there, not too long after that. So, perhaps we're due for a little bit of a move like that. But, the story remains the same. We remain bullish. This is a bullish time period of the year. Our posture is bullish. The trends are set. And while people might not always agree with the valuation of the market, the path of least resistance continues to be to the upside for bulls. So we'll keep our eye on some of those overbought cluster signals and any bearish divergences or anything else that creep up along the way. But for the most part, this remains a market that wants to rally into the end of the year. So we'll continue to try to take advantage of that to the bullish side. Let's go ahead and take a look at another chart setup. In this case, let's take a look at our 3 green arrows. This will be chart 4D for those of you following along at home that are premium members of Market Scholars that have access to our 50 different customized charts. Keep your eye on your email if you're not a client of ours yet. We might be having a little bit of a Black Friday sale later on this week. So if you did want to kind of look into our services and see kind of what we offer from the perspective of premium education on our daily trading rooms, in addition to the scripts and other tools and resources we give you. Make sure you're taking advantage of that later on this week. So anyway, as we look at this particular chart setup, it is our 3 green arrows chart setup. Right now, we only actually have 1 out of our 4 charts that have 3 green arrows, and that is the Russell 2000. As you can see, that small cap index does have that light green shading all the way to the right-hand side of the chart right there. Reason for that is we were able to get our green arrow on the MACD histogram here today on the small cap index, and that completed the 3 green arrows signal right there. And so that is basically a sign that right now, all else being equal, this is a fairly strong time to be looking at establishing bullish trend trades for stocks that kind of look like the Russell 2000 or maybe smaller types of companies. And the other charts look just fine as well. It's just that we're not quite to 3 green arrows yet. We'll probably be there sooner rather than later. You can see that the MACD histogram on the S&P 500 as an example is almost touching the zero line right now. So another day or two of rallying on the S&P 500 and I'm sure we'll be back to 3 green arrows there. So if that happens, we'll do our best to keep you informed of it. Let's go ahead and take a look at our longer term chart now. This will be our 1040 crossover method chart. This is chart 4C for those of you following along at home. And as you can see, things continue to look quite bullish from this chart's perspective as well. Remember, these charts go back over 3 years, and so it gives us a much longer view, a kind of a more intermediate term view as opposed to a shorter term view. So this kind of gives us a sense of what's been happening with the markets, and for the most part it's been bullish. We had the exception of that about a year ago into the end of the year where we had kind of that pink portion of the chart there where we did have a bearish crossover when you're using the 10-week versus the 40-week moving average, but that was resolved relatively quickly. As you can see here, basically by the end of February on the S&P 500 we had a bullish crossover and we've remained bullish ever since, and that's been the case with most of our indices with the exception of the Russell 2000, which has shown a little bit more chop and slop sideways there. Otherwise, the other indices have been rallying bullishly more consistently along the way. So for those of you that have maybe a 401k or other types of accounts where you're not able to trade quite as often as you might like, something like a 1040 crossover method might be useful for you to establish your basic posture. So basically, since February, your basic posture should have been bullish, at least according to these charts. Let's go ahead and now do a little bit of 12 grid analysis. Coming on over here to chart 5A. This is our asset class 12 grid. And as a reminder, when we're looking at these 12 grids, the background colors of the charts will tell you whether we have a bullish or a bearish posture. And the different shades of the colors will tell us whether that posture is weak or strong. So as an example, if we wanted to use high yield bonds kind of here in the middle of the screen, notice that that is a light green background, whereas the chart directly below it with oil, USO, is a dark green background. So the light green means it's a weakly bullish posture. The dark green means it's a strongly bullish posture. So right now, oil continues to work its way higher. We've seen a little bit of positive momentum in that particular area of the financial world. We've even seen a few of the oil stocks start to perk up a little bit. We'll see if that leads to anything. As most of you are aware, the oil stocks have been a house of pain for quite a long time at this point, and every time it seems like they're going to start rallying, they get squashed yet again. So we'll see if this time is any different, but at least right now we can see that risk appetite is there to give oil a little bit of a boost. I mentioned in the intro that interest rates fell today. You can see that the TNX was down here for the second straight day, and what that means inversely is that real estate was up for the second straight day. Remember that REITs and bonds and utilities are typically inversely correlated to interest rates. And so when interest rates fall like they did today, REITs have a better chance of doing well, and that's exactly what they did. They were up 1.33% today. So that was a pretty aggressive candle we saw there. Now, where it stands is, right back to that downward trending moving average. And so that can potentially act as support as resistance in this case, like it did the last time around here, basically in the middle of November. So we'll see where that takes us, but the REITs were one of the leadership groups of the day as a result of those falling interest rates. You did find that bonds benefited from that as well. You can see that TLT, which is the long bond here in the United States for its government securities, continued to rally. We also saw foreign bonds rallying, so there was some life to those areas that had kind of been forgotten about there maybe a month or so ago. And then, of course, I already mentioned that the markets, the stock markets themselves have been pretty strong here recently. You can see that EFA does continue to have that bullish posture. However, it is worth noting that EEM currently has a weekly bearish posture. So it's not strongly bearish, so it's nothing to get too worked up about. Price is still above a rising moving average there on EEM. It's just that the market forecast technical indicator is telling us that below the surface, there's a little bit more of a struggle than it may appear to the naked eye there. So we're going to keep our eye on that. Right now, it seems like the stronger, more robust trends are going to be coming from the more developed areas of the world. Moving right along in that same vein, let's go ahead and talk about the global stocks primary 12 grid, which will be chart 5E. And here you'll see areas like Japan doing very well. Now remember, Japan is going to be considered one of those developed foreign countries, not one of the emerging ones. And so that makes sense there. You can also see Germany holding up quite well. You can see the United Kingdom. You can see France. You can see Canada. Those are all holding up pretty well, and those would all be considered developed foreign countries. India is a little bit of an exception to the rule. They are considered emerging markets at this point, so they are doing their best to kind of help offset any weakness that other emerging markets might have right now. One area of concern is Brazil. You'll notice down here, Brazil, after having a little bit of a rally back attempt up to that 30-day moving average, rejected it and pushed that price back down, and we actually hit a fresh intraday low for the last month or so. It would take us all the way back to this candle here on October 16th was the last time we touched as low as we did here today. So that's over a month. So keep your eye on Brazil. If you're looking for bearish trade setups, it's kind of an interesting setup there where we have that rejection of that 30-day moving average and showing us a little bit of weakness within emerging markets, generally speaking, compared to the developed markets around the world. Let's look at the secondary markets now, or the somewhat smaller economies. If we look at chart 5G, that should get us done. And as we look at these particular charts, I would say that the strongest two charts on the board are probably Switzerland, which is in the lower left-hand corner, and then also Taiwan, which is in that bottom rung, kind of third from the left there. So Taiwan is looking strong. However, be aware that Taiwan did get a overbought cluster signal today. We'll see if that leads to anything or not. You can see that it had an overbought cluster signal over here in September, where it effectively just went sideways after that for the next couple of weeks. So, it did kind of tell you that, that it had gone up too far too fast. However, this next one right here with October 4th being the date, that one looked like it failed. And a lot of my research has shown that the overbought clusters have less of a chance of success in terms of reversing the pattern or the price action compared to oversold cluster signals. Those ones actually have a better hit rate. So as an example, you can see right here with Turkey, we had this green dot on here and it launched higher immediately after that. So I see that type of behavior much more consistently than I see one of those red dots lead to a massive meltdown. Oftentimes it's just kind of a catch your breath type of a moment more than anything. So we'll have to see if this leads to anything on Taiwan. What I do know is that it does continue to have a strongly bullish posture, and it is in a consistent uptrend where it hasn't even touched its 30-day moving average since going way back here to August. So Taiwan has been one of the stronger areas of the world. In terms of weaker charts on the board, I would probably point out Spain, Mexico, and Indonesia. Those are the three that happen to have that darker shade of pink on the board as well. You'll see that all three of them not only have the dark pink background telling us that we have a strongly bearish intermediate posture according to the market forecast technical indicator, but you'll also notice that the 30-day moving average tips on all of them are currently red, and what that signifies is price is below a falling moving average. So with the recent deterioration in price in the last couple of sessions, it's been enough where it's actually starting to pull the moving average lower at this point as well. So those charts kind of remind me of the Brazil chart we looked at on the previous chart setup. So Brazil, Spain, Mexico, and Indonesia seem to be areas that if you're looking for bearish types of trades, there could be some possibilities there. Let's go ahead and talk about our sectors here in the United States now, over here with chart 5C. mentioned earlier that the real estate did really well today. It was up 1.39%. You can also see that its cousin, the utilities, was also up 0.33% today. Those two usually move in lockstep with one another depending upon what's happening with interest rates at that moment in time. One of the other ones that isn't quite as interest rate sensitive but yet is still known as a defensive area of the market is the consumer staples, which you see down below. That chart actually looks a lot healthier. Notice the difference between consumer staples right here versus utilities and real estate over here. Utilities and real estate both have those red moving averages that are clearly sloping lower, where price is struggling to consistently stay above the moving averages. With the consumer staples, it's not really that story at all. We have a green moving average here, which is telling us that price is above a rising moving average. And the price itself is way up here, kind of near a multi-month high. It's not quite past where we were trading on this candle back on September 5th, but it's right in that neighborhood. And you can see today was a really aggressive upward sloping candle there that bounced off the moving average yesterday. So kind of a nice 1-2 punch there in terms of the last couple of days of price action off of that rising moving average. Consumer staples were up 0.81% here today. The other charts actually look pretty strong as well. You do see that the materials have that light pink color to their background, telling us that we do have a weekly bearish posture. But as you look at the price action, it's actually quite promising development here. We've been up 3 days in a row on the materials, and it's a nice bounce up and away from that rising moving average there. So for the most part, we have positive price action coming from multiple sectors out there. It's not just one or two that are kind of pulling the market up with it. It seems like the majority of sectors have very strong price action out there, telling us that this is a market that has a bit more breadth than you might assume, and that breadth is quite strong. That was one of the things that we talked about in my Monday top-down trend trading class here this past week, which is new highs actually achieved slightly more this past week than they did the prior week, and that's generally considered a good thing for the risk appetite of the market. Let's go over here to the internet here briefly. First off, wanted to say thank you to those of you that clicked like last time around that I did the video on the 20th. Looks like there were 117 of you that did that, so really appreciate that. Helps David and I get this market outlook video to a wider audience than we would be able to otherwise. Helps encourage us to do these videos as often as possible as well. So if you get value out of these videos, we would encourage you to go out of your way and take the 5 seconds to click like there for us on Twitter or whatever your social media of choice is. I know many of you are on Facebook and StockTwits and Pinterest and all those other areas that we have out there as well. But David and I tend to look at Twitter more often than those others, so that's why you'll kind of hear us prioritize that one a bit more than the others. But anyway, really appreciate those of you that have done that. This is a thankful time of year, of course, with Thanksgiving just around the corner here in the United States, so always an opportunity to say thank you to all of our loyal listeners of this particular video and our premium classes that we've had over the years. We couldn't have done it without you, and we really appreciate your support. Also, while we're over here on the internet, wanted to take a look at the sector selector that was put together on Friday evening. So it's a couple of days stale at this point, but can still give us a general idea of where money tends to be flowing. Now remember, I'm ranking this by 10 different technical indicators, and we're using an equal weighted approach to it. So it's not a market cap weighted approach. So it might be a little bit different than how you perceive the sectors, but nonetheless can give us a pretty good idea of what's happening out there. One of the major things that is worth pointing out is that technology is all of a sudden number one again. And it's been over 3 months since the last time technology was ranked number one. It was able to leapfrog over industrials and financials, which are still doing well in terms of price performance. It's just on a relative basis, technology seems to be doing a little bit better here more recently. Healthcare still ranked number 4 right there. Biotech in particular has been quite strong. And then on the downside, it is worth noting that after after it took 7 months for energy to not be ranked dead last. So last week it went from 11th to 10th, and that was the first time in 7 months that energy was not dead last. It went right back to the 11th ranking here this most recent week. So that didn't last long, but we'll see. As I mentioned earlier, we are starting to see a little bit more supportive oil charts out there, so it is possible that eventually they start winding their way higher. But at this point, that would probably be a more speculative idea. That's the whole purpose of when we're in my Monday top-down trend trading class. We only focus on bullish trades in those top 3 sectors. And one of the things I was mentioning to my students on Monday was that whether we know it or not, a lot of our success that we have in that portfolio that we manage is as a result of what we're not buying just as much as it is what we are buying. So it's really easy to see where your success or lack thereof is on the purchases that you're making in real time. But sometimes you forget that the decisions where you intentionally decide not to buy a certain stock or not to buy a certain sector can really benefit your performance over the long haul as well. And we haven't owned any oil and gas stocks in that top-down trend trading class for over a year, and that has really benefited us, as that has been an area that has continued to lag the rest of the market along the way. So anyway, market's always here to teach us important lessons like that, but that's kind of where things stand in terms of sector rotation here currently. And I would say this is a pretty bullish makeup of the sector selector right now, where we have more of those cyclical areas leading the market. That's generally a good sign for risk appetite. All right, let's go ahead and now pop back on over here to the Paper Money platform and talk about our trade application example for the day. And I mentioned in the intro, it was going to be on a stock, a rare stock that was down today. And it was a company that reported earnings, and apparently that was not well received by Wall Street. So let me pull up chart, let's do 2A in this case. This is the long-term chart that we use in my dividend growth investing classes. This is the dividend stair-step chart. And this gives us a good sense of where support levels might be on various charts out there from a longer-term perspective, where we feel a bit more comfortable purchasing stock. And of course, that's a longer-term view, but we still want to buy when we are perceived to have value. And that approach has been working quite nicely here recently. In fact, earlier this week, there were 2 stocks that were announced to be bought out at big premiums that we have had exposure to in my dividend classes along the way. So we had some very robust gains coming our way as a result of those buyouts. So will it work that way every time? Of course not, but when we can get a few buyouts here and there, it certainly helps support our performance over time. So this is just one way to look at longer term investing through the lens of a dividend growth investor. In this case, I'm going to look at CBRL. This is Cracker Barrel. This is a restaurant company here in the United States, so I know we have an international audience, and not all of you will recognize Cracker Barrel the way that you recognize Starbucks or McDonald's, which are also excellent dividend growth stocks. But here in the United States, Cracker Barrel is a very well-known restaurant company that is oftentimes kind of known for Southern cooking, and oftentimes you'll find their restaurants just off of the interstate. So anytime you're on a road trip, perhaps on the way to Grandpa and Grandma's house this week for Thanksgiving, you might see a Cracker Barrel off to the side of the road there. Well, today they reported their earnings, and they disappointed Wall Street. You can see this stock was down 4% here today. That was a pretty significant pullback for this type of a company. But as you're looking at this chart here, you're noticing something that hopefully stands out to your eye, that this stock tends to bounce when it gets to this blue line on this chart. This blue line on this chart is effectively plotting an area where a stock is deemed acceptable for a dividend growth investor if they are looking to purchase a stock at an average high yield. So that is kind of a proprietary scoring methodology that we use and then plant into our ThinkScript codes here at Market Scholars that we supply for our premium members of our business. And so if you're interested in this chart and all of the education that comes with it, again, I would reiterate to keep your eye on your email if you're part of our email distribution list, and perhaps there will be a Black Friday sale there waiting for you. But anyway, as you can see, this stock, every time it touches the blue line, tends to establish some support. You can see that it was over here below the blue line for a brief period of time in 2014 and then rallied. Came back down to the blue line right here and then rallied. Came back down to the blue line and rallied. Came back down to the blue line, put in that oversold cluster signal there as well. That's what that little green dot means, and rallied. And then it came back down to the blue line a couple of more times here in 2018. One of those times it was also giving us one of those oversold cluster signals right there, and then rallied. Well, here we are again. After today's pullback, we're effectively down there on that blue line. Now, technically, the blue line's price is 150.29. I'm kind of showing you that here at the top of my charts. So the current price of Cracker Barrel where it closed here today was 151.13. In other words, it was about 80 or 90 cents above that blue line as it stands right now. I was looking at this just before the market close, and it briefly was actually showing us an oversold cluster signal. Now remember, these are weekly candle charts. This is a 10-year weekly candle chart we're looking at here. So those oversold cluster signals are few and far between. We got a few of them right over here. We got one of them right there, and we got one right there. So really in 10 years, there's, from what I can tell, only 1, 2, 3, 4 instances of weekly candle oversold cluster signals. And we would have had our fifth today if we would have closed at the low of the session. But we bounced a little bit at the end of the day, and so that took it away. But nonetheless, it's within that zone of being oversold and at the same time being at an acceptable yield level, in this case close to 3.5% dividend yield on a stock that has raised its dividend every year for quite a long period of time. So I thought this would be a good stock to kind of highlight that concept of long-term investing, trying to buy higher quality merchandise when it pulls back in price to a level that is acceptable for a long-term investor going forward at an above average yield, in this case 3.5%, where that stock typically bounces, or at least has shown the ability to do so here over history. So in this case, we could just buy the stock outright, but with the stock being just a hair above the blue line right now, another alternate way to consider establishing a position in a Cracker Barrel or any other type of a company is to sell a put. Selling puts is a way for you to effectively take in premium for your willingness to buy a stock at a cheaper price than where it is currently trading. And so if I were to come on over here to the trade tab and pull up ticker symbol CBRL, I'm going to come out to the January contracts that have 52 days left until expiration. Then I'm going to come on over here to the right-hand side of the Thinkorswim platform where they plot the put prices. I've got a column here established for ROR, return on risk, and I typically look for one that has close to 1%. In this case, you can see I've got one very close to it. It's 0.97%, so it's about as close as you can get there, and that is the $140 strike there in January. And you can see you could probably get filled at about $1.35 right here, assuming that this opens up at about the same price that it closed here tonight. So, you know, you're making about 1%. You are then on the hook for buying that stock at $140. So again, that's an $11 discount from where it's trading right now. So your yield on cost would actually be much more than the current 3.44%. It might be as much as like 3.6% if you were forced to buy it at $140 itself. So for those of you that want to buy it right now, you could just go out and buy the stock. For those of you that want an even deeper discount than what it's already offering, then perhaps selling a put has that potential. Now remember, if the stock doesn't close below 140 on expiration day, you probably will not be put this stock. But you do get to keep the $135 when you sold that contract up front. So it's kind of a nice little partying gift if you don't get put the stock that you wanted in the end. So in order to place that trade, I'm just going to click on the bid price here. I am going to change this to 135. Again, that's the midpoint between the bid and the ask where it closed here today. So I'm going to try to get filled at 135 here. I'll go ahead and change this to a good till cancel order as well, just in case it doesn't get filled tomorrow. And I'm just going to do one contract here and click on confirm and send. There's $135 approximately that'll be coming into our account, and then we'll see if we get put that stock come January expiration cycle. All right, thank you for joining me here yet again. Markets continue to be very bullish as we head into the Thanksgiving holiday here. We'll probably have a little bit lighter volume tomorrow as a few people start unplugging from the markets a bit more. I still have my class tomorrow, so if you're a premium member, come on over to my swing trading class tomorrow morning. Should be a great time as always. And then I'll plan on getting this video out tomorrow afternoon as well. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.